Hi everyone. So I'm just from a meeting with a client here, and I'm kind of compelled to talk a little bit about the money market funds. Now, there's still a little bit craze about money market funds and what's going on in the markets as the rates are actually dropping, and many people are complaining on why are the rates going down. Especially people who joined late last year, probably, and early this year. Uh, it's something they're not finding pleasing. So many people are complaining why the rates going down. People like to ask it's a safe haven to go put your money into, and now the rates are going down. And so I'm a little bit concerned on how people are perceiving this tool. Money markets have been there for a while, and it's not a new tool that people are using now. So the problem that I find with this tool is that people don't understand how money market funds are actually structured. So these are collective investment funds that are managed by companies such as banks and insurance companies, who are mostly the ones who are pioneers of this product. And what happens is that the fund manager collects funds from different people, and your money is put into an asset, the underlying asset. So what people don't understand is money markets have underlying assets where the fund manager puts your money into, and those assets determine the rate of return that you will get. So most money market funds will find that they invest their money into treasury bills and treasury bonds. Why? Because they're more liquid, and a money market fund is designed to be liquid. So hence the fund manager cannot put money into assets that are more volatile or are not guaranteed obvious returns that much. So they put those collective investments, those collective funds from different various investors into treasury bills mostly, and treasury bonds. So as we can see, if you're an investor, supposed to keep up with what's happening in the markets, both locally and internationally. And currently the interest rates are going down. Last year we had bonds going up to 18%. That is why you could see even treasury bills going up to 13-14%. And so the money market funds were able to give back better returns. But right now they're on even one digit, the treasury bills, and treasury bonds are actually coming down to 14-13% if you're lucky enough. So money market fund managers actually also the underlying assets, which are treasury bills and treasury bonds, are giving back those little returns. Now, another problem I think many people have is FOMO. So many people join money market funds out of FOMO is fear of missing out. So because of the high returns that money markets were actually having, we saw even on the social media, people sharing how they are getting those high returns from money market funds. Hence, many people actually ran into it and just started saving money into money market funds without actually understanding the first problem that I've said, not understanding how they are structured. And interest rates are not things that are fixed. That thing, it's something that keeps on changing. But when that changes, money market funds don't give you guaranteed fixed return even on a month. That fear of missing out is people just jumping into it without understanding, first of all, what to expect in terms of returns when the markets are up and when the markets are down. So that's another problem. Another thing I think that people did not look at or are not actually keen on is many people who are going into money market funds, they probably don't have that much income, and so they saw it as a safe place to invest their money. And money market funds, as we said, it's not a place you go to invest your money, or you want to double your money, or you want to build wealth with it. It's a place more of a saving tool. And a saving tool in this case, we say you don't have to expect high returns on a savings tool, because it's just money you're putting there so that if anything happens, you have a cushion somewhere. It's not money that you want to build a generational wealth with, especially while you're starting or when you're starting, because the compound interest is exponential as you go by, as time goes by. So you'll find that most people who are actually getting good returns from money market funds have done it like even after 2 years is when they start seeing some substantial returns on their account. So another problem I think that is there is that people wanting high returns but do not want to take risk, because a money market fund is a very, very low when it comes to the cadre of risk. It is on the lower level. So you want to earn high returns, but you don't want to take risks. People who are taking risks are people who are going to put their money into businesses. You invest as an angel investor, you buy a business, or put silently or quietly be an investor in a business. Go do farming, go do run or open your own business and start running it. Those are ventures which mostly will give you high returns, will give you better returns compared to a money market fund, but in turn they are more riskier kind of ventures compared to an MMF. Another venture is you can try a stock market. You can start investing into the stock market. Again, it could be slow. It depends with the market, but it is volatile compared to a money market fund where your capital is actually guaranteed. In these cases, capital is not even guaranteed, especially, for example, look at the people who go into farming. You have to take time to even learn the challenges and the things that go into farming for you to eventually start making money out of it or managing those kind of risks. So we shouldn't expect high returns in a product like a money market fund, whilst it is a very lower type of a risk. Also, I think people need to go out and make money. The money that you make from your business, from your career, if you earn a good salary, that is money that you're supposed to be saving into a money market fund. If you're just there every day checking into your money market fund account to see what have you earned on your account, I don't think you're doing enough in terms of your income streams. Be busy, go out there, make money, do some businesses. If your career is doing well, upgrade your ladder if it's possible. Make that money. Then that money that you make, the profits that you make from a business, and the risk that you take out there, that money that you make, that is the money that now you put into a money market fund. When it comes to maybe saving for emergency funds and something like that. So when you have a goal towards saving, you want to save for 1 year emergency funds or your expenses funds, that money, we say put it in a money market fund is better than putting it just in a kawaida savings account. So with that goal, you will not be checking your account every day, how much is it making, because you're just saving money. You're not there to earn a high interest. You have a goal that you want to achieve, and that is the tool you're choosing to